Oh, shit. Y'all caught me yawning. TJ the Wheel Deal coming at you live. It is Friday, Expiration Friday for some people. We don't really play that game on this channel, but it's still Expiration Friday for some people. July the 19th, 9:23 a.m. Central Time, Texas time. A lot of activity in the market this morning. I woke up, I saw that the capital requirement on Robinhood had changed. So that really had an impact, negative impact on a couple of the accounts. So I want to talk about that. I want to talk about that because if you're going to sell strangles, you're going to sell puts, and you're going to sell calls, and they are just short strangles versus covered strangles. This is why, I have that thumbnail. I had Alex do that thumbnail for us. Buying power is such a critical element. It is a very critical component. So I want to make sure that you guys understand the gimmies and the gotchas. Big account, no issue. No issue. We have like $7 million of buying power. The buying power went down like $500,000 overnight, just like that, because the algorithm doesn't like the risk reward on Robinhood, because Robinhood was going up and to the right, and you have an unlimited risk to the upside whenever you're selling a naked call. So it's going to adjust for that, right? It's going to protect you. In other words, it's going to compress your buying power so that it forces you into adjusting that position or trimming the position, closing the position, whatever. It just doesn't like the risk profile anymore. That's why it's there to protect you. It's not there to be a pain in your ass. So I want to really go into those intricacies with you guys, because I feel like a lot of you guys will sell too many contracts, and then there's an expansion of implied volatility, or there's a change in capital requirements, and then now you're like, holy shit, what I do? What I do? Anyway, for those of y'all that are new to the channel, my name is TJ the Wheel Deal. I sell puts. I sell calls for a living. I roll when it makes dollars and cents. I buy the timely leap. And here lately, I've transitioned to short strangles. This is where you sell a short, it's essentially like cash secured put in a covered call, except you don't own the shares. The short put functions the exact same way as a cash secured put, naked, uncovered, whatever. You have to have buying power for that. You got to be prepared to take assignment. But the difference is the call. The short call is not the same as a covered call because it is not covered by the shares. So whenever you have covered calls, they're like, oh, you're capping your upside. Yeah, but you're also, you don't have a cap on your downside. You're not going to lose an unlimited amount of money, potentially. Whereas with a short call, an uncovered call, a naked call, it is then squeezes. Let's say Robinhood squeezes to like $250. At some point, you have to deliver shares at 250, and you don't own them already. It would have been a lot less painful to own the shares and have them called away at $135, and you're just crying on X about it. You know what I mean? But you don't have to worry about making good at 250, if that makes sense. So you got to really understand the differences between a short strangle and a covered strangle. So what I want to do is I want to beat that home. So I'm going to go differences between a short strangle and a covered strangle. Now I'm going to use AI here to help me a little bit, because I just feel like this AI is just better at explaining shit than I am. So what I'm going to do now is I'm going to do a little present action here. So we're going to remove that. We're going to try to, present, stop screen. So we'll go present, share screen. And let's see if that shows up on it. Hopefully it does. I'm waiting a couple seconds because I have it on the TV over there. And yeah, okay, we're good. So I know it's on there. Super. So let's talk about it. A short strangle involves selling both a call option and a put option with different strike prices on the same underlying asset, aiming for both options to expire worthless, meaning out of the money. A covered strangle combines a short strangle with a long position in the underlying asset, e.g., owning the stock. The key difference lies in the added stock ownership. A short strangle has unlimited risk to the upside. The covered strangle has the same risk profile to the downside. The shares could go to zero theoretically, and you're obligated to buy them at your strike price. So the same risk profile to the upside, but the biggest difference in the risk profile is to the upside, guys. The difference lies in the added stock ownership. A short strangle has unlimited risk, it should say, to the upside, while a covered strangle limits the risk on the downside due to the long stock position. Here's a more detailed breakdown. Short strangle strategy. Sell an out of the money call option and an out of the money put option with different strike prices on the same underlying asset. Objective. Profit from time decay, theta, of the options and limited price movement of the underlying asset. Risks. Unlimited potential losses if the underlying asset's price moves significantly beyond either strike price. Reward. Capped at the net premium received for selling the options. When to use? When the market is expected to be relatively stable with limited price movement. That is not the only time that I use them, obviously. I like a short strangle whenever I feel like the stock is pretty overbought, kind of like Palantir and Hood in this case. I love them for the short strangle because in my mind, there's not a whole lot of risk to the upside because these things have run, and if they run, it's like, oh, it's an extra 10%. Oh my God, but it's only like 10 or 15 bucks. You know what I mean? So it's very easy to manage for me. Again, I'm a little bit different though, like the way that I look at everything emotionally. Selling a call option with a strike price of 105 and a put option with a strike price of 95 while the stock is trading at 100. That's an example of a short strangle. That would be very, very tight. I can't see me ever doing a strangle that tight. Covered strangle. A short strangle combined with a long position in the underlying asset, meaning you own the shares. This can be achieved by buying the stock and then selling the call and the put options, or by holding a long stock position and then selling the options. Objective. Profit from time decay and limited price movement while limited downside risk with the long stock position. Risk. Downside risk is limited to the difference between the stock purchase price and the put option strike price minus the premiums received. Upside risk is capped at the call option strike price. So Robinhood, you own the shares. You have a covered call at 120 versus a short call at 120 if you own the shares. Worst case scenario, you make a profit if you own them right now because it's trading at like 110, 111, 112, whatever it is. And then you sell them at 120. So you make that $8 of capital appreciation. You make your money from the call premium. And then you get a cry on X about it. You get a cry on the WhatsApp group about it. Oh my God, I left all this money on the table. Short call. You don't own the shares. You sell the call at 120. This shit goes to 200. Now you're crying on X in the WhatsApp group for whole different reasons because you're uncovered, right? So y'all can see that the pain profile is a little bit different there. That makes sense. The reward. Capped at the premiums received plus the difference between the stock price and the call option strike price if the stock is above the call's strike at expiration. When to use? When bullish on the market but want to generate income and limit downside risk. Example, buying 100 shares of a stock at 50, then selling the 55 call and a 45 put option on the same stock. So I like the covered strangle whenever I'm kind of unsure about the stock. Like I considered one very, very recently. I didn't do it because it's just not a huge position for us, but it's EOSE. EOSC, I did the short put at 4. I did the short call at 6. It was trading like at 5. And I was like, maybe I should just buy these damn shares. I don't want to have to monitor the position. Because in my mind, if it goes to 10, who gives a shit? I sold the shares at 6. I made money there. And then the put premium was mine free and clear too. Onward and upward to the next one because it's a very low conviction play for me. Because I haven't done much research on it. It's a battery play or some shit, and there's a couple of people excited about it on X, and I I just kind of like followed them into the ticker, if you will. But I used a strategy that I felt like I could, kind of maximize the money that I was willing to, that I wanted to make on the shares with the kind of exposure that I wanted to the stock. And it's since breached the strike price. So I'll pull up the portfolio in a little bit and I'll show you how I'm navigating everything. But I just wanted to kind of like give you all a little, the difference between the short call and the covered call. The short put and the covered put is effectively the same. The only difference is the capital requirement up front. But make no mistake about it, you got to make good on those short puts, and they're not going to really let you do them on Tasty Trade if they don't see that you have the money to go buy those shares, if that makes sense. So let's get into it, guys. Let me remove this here, stop the screen, and then let's see what's going on with the portfolio. Things could have changed a lot here in the 10 minutes that I've been talking to you guys. So here we go. Hopefully that shows up. I'm giving it a couple of seconds to show up over there on the screen on my TV. Okay, we're good. I know that it's on the screen. So let's get into this thing, guys. Make this a little bit bigger to see. So we're going to start with the little portfolio today, because the little portfolio of my son's account does not have a lot of buying power. So I have to be very, very careful with short strangles, right? So let's talk about it. Hood, what's going on with Hood? Real bad day, right? Down $6,300. Holy shit. Let's talk about it, right? So this happens to a lot of you guys. I feel like you look at that, your heart starts beating real crazy, your blood pressure gets out of whack. When I look at it, I'm like, okay, well, let's open the position and let's really see what's going on, right? So I click on it and I'm like, okay, well, what's going on? So I've got a 95 put and a 120 call. It's still on the sweet spot. I'm like, so what's going on? Oh, I get it. It's up $6 today. So there's a lot of pressure on this short call. So this short call must be getting hammered. And sure enough, that's what's going on. Now, you'll also see that I'm down on the puts. So how does that happen? How can you be down on the call and down on the put at the exact same time? It's because you got to look at the order chain. You got to look at the order chain here. So there's 4 roles involved here. So I'm going to go here. I'm going to pull up the order chain over here. And you're going to see, where is my order chain? Where's option when I need it? Here we go. Order chain. So what happened was when I started this strangle, we go to the bottom on 7/14, not too long ago, right? We're talking about 4 days ago. We started this position with 25 contracts, 70 on the put, 120 on the call. Go where it says Hood on the far right to the bottom. That's where the cursor is. So I'm going to take my time and really show this to you guys. So you're going to see on the very bottom, strangle, and then you're going to see roll, 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 and then you're going to see the open position. So we started with 70 and 120, and you're going to see a common theme here. The 120 hasn't changed. So we started with 70 and 120. We sold the short puts at 70. We sold the short calls at 120, and we got some money, 3.6. So $360 a contract, not bad. Felt real good about it. And then looked up, and I saw that Hood kept going up a couple of days later. So I was like, okay, well, the delta is pretty low on the short put. So it's not really helping me. It's not really helping me because the short call has a higher delta. So I rolled the 70 to 75, picked up another 31 cents right there. So not bad, $31 per contract. And then the next day I looked up again, and this is all in the morning, right? This is when I log into the account and I go again because there's only 3 positions on here. So then I'm like, shit, this thing keeps going up. So I went again, and I was like, okay, I'm not going to touch the short call, even though that's the side that is getting challenged. It is in your nature to go deal with the side that's getting challenged. But the Tasty Trade way says, hey, no, go get more credits from the side that's not getting challenged. So I followed the Tasty Trade method here, and I rolled from 70 to 75. Then I rolled from 75 to 80 on 7/17, picked up more credits, 37 cents, $37 a contract. And then later on in the day, I was like, okay, this shit's starting to get out of hand. So I went from 80 to 90, picked up more credits, $1.63 or $163 a contract. All the while I haven't touched the short call. And then this morning at 8:45, I went from 90 to 95 and picked up another 94. So this is just a game of credits, guys. So I started with $360 or $3.60 per share for the contracts, but it's all multipliers of 100, right? So this is $360 a contract. Then I picked up $31 a contract, and it's still 21 contracts, so do the math. Then I picked up $37 a contract on the rolls. This is just on the put side. Over here, I got $360, but it's 50 contracts over here, right? Because there's puts and calls. Over here, we're just rolling one leg of the strangler, if that makes sense. So there's $31 times 25, $37 times 25, $163 times 25, and then $94 times 25, and it gives you the cumulative over here. So it picked up $685 a contract. Not bad. And the open position now sits at exactly what it shows over here. 25 short puts at 95, 25 short calls at 120. So then now I got to look at, let me minimize this, and I got to look at, okay, well, how do my deltas look? Am I delta neutral? Am I still going to get clobbered to the upside? Because right here it's showing that I'm still short deltas, negative 0.21. So for every dollar, this is the position delta. So for every dollar that Hood goes up, costing money right now, because the delta on the short call is 40. You see over here on the far right, you're going to see the negative 0.40, whereas the delta on the short put is only 19. So what would help this position the most is, one, the passage of time, because you see this little snowman right here with the line in the middle. That's your delta, that's your theta. So we're collecting, all things remaining equal, $694 per day. There's 28 days left on this contract. So that helps, one. Another thing that would help is if Hood went down to, like, say 108, because that would lower the delta on the call and give me more of a delta neutral position. Another thing that would help is I could take all the credit that I've received from the puts, and I could sacrifice those credits and increase the strike price on the call so that I'm further out of the money. So that's another option that I can do. It's like, I got all those credits for a reason. I don't want to move the expiration date. Not yet. I want to wait till I get to 21 days to expiration. So if I just want to be more comfortable, one thing that I could do is I could be like, I go from 120 to 125. What would that cost? So that would cost $3,400, and then it would take me from a 40 delta to a 33 delta. So now we go see, because that's going to cost $3,400, right? So we're going to clear that because I don't want to do it. Now we're going to go back to the order chain and see, hey, could I afford that? Could I afford that? So there's 31, there's 37, there's 163, there's 94. So we're going to call this 260, call it 250 for easy math. $3, a little bit over $3 for easy math. And then on this roll, if I go over here again to the roll strikes up, I go from 120 to 125. We can definitely afford that and feel a lot better about the position just by simply rolling up the 120 short call to 125 and just feel a lot better about it. But I'm not going to do that. I'm not going to do that. Why? Because I just don't feel like it. I don't feel like it's necessary. There's enough buying power here. I think it'll be okay. I would rather continue to roll up for credits than to roll up for debits, especially since I'm pretty far out of the money. Because the one thing that I could do to make this position more delta neutral is I can just roll up the put right here. So I could roll up that put to say 105 and pick up a shitload of credits. Look at that right there. I can pick up $8,500 of credit. It's going to reduce the buying power, of course, because I'm taking on more risk. But now I got a 36 delta over there. Ooh, I don't feel that. I don't feel that great about that, because now I have an obligation to buy hood at 105. All of a sudden, your brain switches, and you're like, you ain't worried about the short calls at 120. You're like, shit, I don't want to buy hood at 105. It's ridiculous. So this is what I do. It's kind of like my little litmus test, if you will. So because I'm not willing to roll up the puts any more than to 100, 100 is probably the absolute max that I'm willing to roll up the put, then the next play for me would just be to roll out the entire strangle, because you can add time and money to the contract, right? Those are the two components contract. So now I could look to go to the 63-day cycle, and I'm trying to take my time so I could really walk y'all through this stuff, guys. So then now I look at the expected move, the copper strip right down the middle of the page, and I'm like, okay, where would I be comfortable? Where would I be comfortable? Because if I leave it right where it is, there's $6 in credits. I don't need to go get all those $6 in credits. I need to go get comfort, right? I need to go get comfort, increase my buying power. So the first move that I would like to make, but again, this is we fast forward next week, Wednesday, Thursday, Friday is when I'm going to look to manage this position, is I would like to go from 95 to 90. That's move number one, sacrifice some credits. We already went from 6 to 457. And the other move that I would like to make is to go from 120 to 125. Now I feel pretty comfortable. Again, it's still a 21 delta disparity, if you will, right? Because it's 19 delta on the short put, it's 40 delta on the short call, but I'm picking up $291 in credit. Or I could get even more comfortable and go to 130, and I'm still picking up some pretty decent money. And I go way more delta neutral, because instead of a 40 delta on the short call, I'm now sitting on a 35 delta on the short put on the short call versus the 19 delta on the short put. If I leave the short put where it is, I leave it from 90 to 95, I can pick up more credits. So that is also an option. This is where you got to do you. This is why managing options is more of an art form than a science, if that makes sense. What I always try to aim for eventually is I want my strikes to be on the edges of the expected move. That's what I'm building towards, but it might take me 4, 5, 10 rolls to eventually get to that point. But I don't want to keep, push and push and push. About 63 days, no more than 90, unless there's some circumstances or something that I'm just like doing because I have like a huge ass year-to-date loss or something. And I just wanted enough credits on the extrinsic value, because I did that on Soxol. I was like, let me just pick up more credits on the extrinsic than I have on my year-to-date negative. So I kicked it out like 3 or 4 or 5 months or whatever, so that it's just a theta decay play. So this is something that looks pretty attractive. And you look at it and boom, you pick up $7,400 for your trouble. You feel a lot more comfortable. You stay at 95 on the put. You went from 120 to 130 on the call. And you're basically just saying, hey, I'm excited for Robinhood. I don't necessarily have to cheer against the stock here. I don't have to be that guy. But I like for it to kind of chill out and consolidate a little bit. And this really improves your chances to win. If Robinhood continues to go on a tear, 20, 30 days after that, you can do the same thing and eventually find yourself at 140, 145, 150. And if you just keep doing this and doing this and doing this and maintaining the level ahead, eventually the position will work itself out. Another thing that you could do to work itself out quickly is just buy the shares and cover if you're able to. In this little account, I don't have the money to do that. I don't have the money to make good on 25 contracts on Robinhood. So I knew that going in. So I was just like, I will manage this trade accordingly. And eventually it's just a game of credits and debits. I know that eventually with the passage of time, things are going to work out in my favor, and I'll figure out how to manufacture the win. Again, I'm a little bit more experienced. And also if things got dicey, just full disclosure, I could send 5, 10, 15, 20, $25,000 to the account and beef up my buying power and really improve my overall position. So that's how I'm navigating Hood in the small account on SoFi. I didn't do anything today. On Enphase, didn't do anything today because yesterday I rolled this, right? Yesterday I rolled it for a pretty nice credit, and we're sitting on a real nice year to day there. On SoFi, we're up 150 bucks for the day, so not too bad. And again, the one that's getting its ass kicked is Hood. I think it got as high as like 113 earlier or something like that, and now it's coming back down to reality. So if it goes, down to like 110, 109, that P&L for the day might not completely go away, but it'll go away quite a bit. But what will always be real is the data collection. This data collection is making its way over to the net liquidation every day, every day, every day, all day, all things being equal, right? All things remaining equal, share price, applied volatility, all those things, which doesn't really happen, but time's running off the clock because it just feels bad, but it's not as bad as it feels from the standpoint that 111 is still pretty far away from 120. That's just the reality of it. So I still feel like that's going to be a winning trade. I don't know if it'll be a winning trade on this cycle, but eventually it will be a winning trade because I can keep inching the strike price up on the short call. But I'm really hoping I don't have to move the short put up more than 100 because I'm just not comfortable there. I'm just not comfortable over 100 on Hood. I think it's not a good deal. I just don't. I don't think it's a good deal if I had to deal with potentially owning those ships down the road. So now let's go over to accounting in 01. Woke up this morning, buying power's like negative $300,000. Yo, what? So I look at it. So let me pull up the order chain. So what happened? So you'll see it right here. So it was this morning. We're going to the far right, and I want you to go to the top middle where it says closing. We started this strangle on 7-8. You'll see all the credits: 261, 281, 280, 261. Just kept adding and adding and adding to this position. But then this morning had the negative buying power. So I had to close 50 of these contracts to increase the buying power. And then I rolled the entire position. I went from 85 to 95 on the puts, got some of those credits, and then I rolled the entire position out from the 28-day cycle to the 63-day cycle. And I went 95 and 135, which is kind of what I showed on my son's account. I already executed that trade and picked up a shitload of credits here, 972. So now if you look at the position as a whole, it looks really, really bad initially. Oh my God, down $37,000 year to date. But what I look at is the extrinsic value. There's $162,000 of meat on the bone here that could theoretically go from the brokerage cash to the net liquidation value. And all Robin has to do now is stay between 95 and 135. So the goalpost is getting wider. On the next one, again, this is a trade that I want to be in for the next 6 months, a year and a half, because I love me some Robinhood. But I would start getting more comfortable if I could keep going like $5, like go like on the next roll, go from 95 to say 90 and 135 to 140. Then at that point, depending on what the market's doing, crypto, everything else, I may try to just wait it out so that I could log the win. That's kind of the goal on paper. We'll see how it goes. That's the way I drew it out. If it doesn't work that way, I'll make the necessary, I'll make the requisite adjustments. But right now I'm thinking if I can get to 90 and 140 on the next roll, again, for more credits, eventually this extrinsic value will make its way over to the other side of the ledger, and I'll manufacture and realize a real big fat win on Robinhood. Other than that, nothing else going on here. I'd already rolled Palantir on this particular portfolio. So now we're sitting on 120, 170 for the 63-day cycle. And the only thing that's sitting on the 28-day cycle on this one is PayPal, and it's pretty comfortable. at 67.50 and 82.50. So that's all that's going on there. On this account, same thing. Woke up, negative buying power, all because of Hood. So let me pull up Hood, order chain. So what did I have to do? So this morning, you'll see it at 8:31. I closed out 25 of those positions, gave back $535 a contract, increased the buying power. Then I rolled up the put from 85 to 95, got some of those credits back. And then I rolled the entire position out to the 63-day cycle, got 3.25 of those credits back. So if you look at that 3.25, you look at the 155, and then you look at the 535 that I gave back, but that was only on 25 contracts. Here we're getting these credits on 100 contracts, still a net positive for the portfolio on premium collection. Now it still looks and feels ugly otherwise because we got to wait it out. But we're collecting that data. You know, the data's serious on this particular position. Over $1,685 per day, all things remaining equal. This little snowman right here. This little snowman here, this data collection's a real thing. And it's a pretty delta neutral position now at negative 0.06. Not bad. Other than that, there's two positions that are for the 28-day cycle here. So I'll minimize here. So it's PayPal. So we get the short put at 65, the short call at 85. So this one's a little bit more comfortable than the account ending in 01. This is a little more comfortable. The probability of profit is 77%. I mean, it's not bad. 83% out of the money percentage on the put, 88% out of the money percentage on the call. It's on easy street right now. In phase, 35 and 45. I actually like where that one's sitting. I might even be able to ride that one out. Throw earnings or sufficient buying power there, so there's not a whole lot to worry about either. It's a 64% probability of profit. In phase is a little bit more volatile. On Hood, there's a lot of extrinsic value there, $107,000, 95 and 135. I feel pretty good about it. And on TSLL, this is a real tight strangle, 12 and 14, 63 days out. But you'll see that there's already been $28,000 made in this account year to date because I did a nice swing trade on some shares. And then we've gone through a lot of cycles of rolling here. If you look at the order chain here, there's a lot of rolls over here. A lot of rolls over here on TSLL. There's a lot of activity. Let me see, look at that. There's just a lot of activity on TSLL. We're sitting real pretty on it. I'll be a hell of a lot more comfortable if this thing was like at 11 and like 16 or something like that. But we can get there. We'll get there by the end of the year. We'll probably have a $20 strike price. And also there is a decent amount of brokerage cash here, $562,000. And there's also a deposit of $175,000 coming in. So at any point, I could just cover the shares on TSLL. That way I don't have to keep rolling if I don't want to. We just take ownership of the shares, call life good. So that's what's going on with that account. On this account here ending in 20, there's the only thing that I did is I think I rolled from 85 to 95. So if I look at Hood, go to the order chain. Did I do any? Yeah, this morning also, same thing. I went from 85 to 95, and that's all that I did. So I didn't roll this one out to the 63-day cycle. It is something that I'll consider. I just haven't done it yet. I haven't felt the need to. And then that's really it, guys. That is really it. So now let's go to the featured account. This thing was down $147,000 this morning at one point. It's kind of chilling out now. So what are the trouble spots? The first thing that I always look at whenever I log on is how's my buying power like? This thing was over $7 million yesterday. Now it's at 6.3. Now that's not all just because of Robinhood. It's because I added a couple of positions, and I'll talk about those here in a little bit. But the one that really, really stands out right away is Oscar. because Oscar is 12.50 on the put, 18 on the call. I was up over $9,000 yesterday when option was on the channel, and he's like, "I get out of that joint," and I'm like, "No, I'm writing this thing down. I want to get to 10,000." Right? Y'all remember that conversation? Roll the tape. It happened yesterday, and now I'm only up 1,500 on the position. Why? Oscar's been getting his ass kicked. So now the short put is down substantially, 48% since I opened it. Got $45 a contract when I sold the 250 contracts. And now those contracts are worth $67. So I'd be down $5,400, $5,500 on that trade if I wanted to take my ball and go home. The good news is I got $48 a contract on the short calls, on the naked calls, the uncovered calls. And those contracts are only worth $20. So I'm up 7,000 there. So that's how you get the net positive now of 2,000 on the position overall. And because I'm comfortable taking ownership of Oscar at 12.50, I feel like I don't really have to do anything. I don't have to do anything. I'm just going to let it ride out at least for another week because the theta is going to increase. Right now, we're already at $1,544 daily. I'm like, I'm going to go grab that money because I feel like I have no risk to the downside because I'm comfortable owning Oscar. I think the floor on Oscar is probably like 11 or 10. So it's a very manageable situation. And I don't think it's going to go to 18. So I'm going to go grab this free money. In fact, I'm tempted to maybe lower the 18 to like 16 or 15 and go get that money. But then I introduce another element of risk. So I'm not interested in doing that because we're still 14 days out. But maybe if we get to that 7-day mark and I want to ride it out to the end, then maybe I'll get a little bit more aggressive on the short call side of things, bring some more premiums through the door, lower my adjusted cost basis if I had chose or had to take ownership at $12.50. Now let's talk about Hood. I feel like that's why everybody's tuned in right now, is to talk about Hood. Before I do that, though, is let me see if there's anybody that has any questions or whatever, and I can address those real quickly, and then we'll get on to all things Hood on the big account. What's going on, Mr. International? The health insurers are strangling my patients. Wakey, wakey, eggs and bakey. Happy Friday. Prablin, what's going on? Shamu, BJJ Black Belt in the house. Options Brit, what's going on? Dax, appreciate you catching us live. What's going on, Mr. G? Tracks compensated. Hey, TJ, what AI are you using? That was just a Google AI that I showed here a while ago. But Grok, I think I subscribed to Grok 4, man. And Grok's impressive. Grok's impressive. What's going on, Chris? Thomas. Good morning, TJ. I have covered calls on Robinhood at 70, January the 26th expiration, so about 5-6 months from now. Any ideas on how to manage? I'm thinking of rolling to 75 April for a small credit. That's something that you could do. I mean, that is something that you could do. Another thing, depending on your buying power, is you can start selling cash secured puts on Robinhood as well at like 70, $75 and grab some of that money so you can stay in that trade longer, milk some of that theta decay. I mean, you've already let it go, roll deep in the money. So it's like swimming, guys. The deeper you are underwater, the harder it is to come up for air. So I would say sell some short puts on it. Maybe roll, maybe take those monies and buy some leaps. That way you maintain some exposure to the upside. Another thing is this is other higher level stuff that I've done in the past. As I close the cover call, I immediately sell the shares, take all that money and buy leaps. Be done with it. If you think it's going to go up and to the right, you're going to make a lot more money on the leaps because they're more leveraged, if you will, than just trying to protect your shares. So again, it just depends on what your risk profile is, your risk tolerance, your bankroll, the amount of patience you have, your genetic makeup. There's just so many factors, guys. This isn't a one size fits all. Appreciate the 1,088 people that have seen the link on X and the 46 people rocking with me live. I know I'm pretty sure it's Friday, so I'm pretty sure Amit's still on. So I appreciate you guys cheating on Amit and watching me over here. Manesh, what's going on? Yeah, exactly, Pathway. What's going on, Noah? Dang, that's me. Pat Boy, my thingy. Hey, what's going on, Brent Singh? We got a pilot in the house. Happy Friday, another pocket filling day. Yeah, I'm glad you're doing really well, Mr. Premium. TJ, can you look at SMH? It's like Sock Soul, but without the leverage. I'm familiar with it. I like the holdings more. Do you think it ran too hot or still possible to do a coverage strangle on it? I'll check it out here in a little bit. At Thomas, I usually try to get out. Let it roll just so more Oscar puts the day right on. Right on. So let's get back into that Robinhood position. So let's go over here and let's really focus on Robinhood over here. Because what's going on? I'm liking what I'm seeing. First of all, I see 110 already. So that euphoria might have, kind of working itself out a little bit. So you got to be able to handle the fire, guys. Got to be able to handle the heat of these positions. Cannot stress that enough because if you're able to handle the heat, you collect some more of that data, and then now you're making moves from a position of control, of like emotional control, a position of strength, versus just like all panic mode and oh shit, I gotta roll that all crazy, right? Imagine if I had rolled it like 100. I mean, I was already kind of uneasy rolling to 95, but I wanted to get more delta neutral, if you will. So anyway, it's one of those things. Like imagine if I just waited an hour to roll, it would have been more favorable to do so, because now getting the ass kicked on the roll, but the call is helping me now too. So let's talk about it. So what's going on with this account, with this position? Got 500 short puts at 95 and 500 short calls at 120. So that's the sweet spot. That is the sweet spot. That highlighted portion is the sweet spot. So the object of the game is for Hood to trade between 95.01 and 119.99, between 95 and 120 essentially, and expire 28 days from now, August 15th. That is the objective of the game. If that happens, and right now, according to the Tasty Trade platform, there's a 56. Now, there's 56% chances probability of profit. That's the chances you're going to make at least $1 on this trade. But the out of the money percentages are 73% on the put and 69% on the call. So this is Tasty Trade basically using their fancy algorithm saying, hey, there's pressure to the upside on this thing. Essentially, be careful. And you'll see the cap requirements here. If we roll the tape to yesterday, the cap requirement was not $1 million on this position yesterday. Today it is. So that came from the buying power. So had I not had that buying power available, I wouldn't be able to withstand this body punch, this gut punch, this blow, if you will. So is the moral of the story here today is your buying power is a very, very critical component to running an effective short strangle campaign. It's very, very important because you're in the money game. You're going to need some money. You're in this, you're selling options. You're going to need some money, firepower. So what did I do today? So let's look at the order chain. So here it is, 804. I rolled from 85 to 95. To the right-hand side, towards the top, you're going to see that roll at 8:05 a.m. And that's all I did. That's all I did. Let me see if I can make it a little bit larger for you guys. Maybe that helps just a little bit. So that's all I did. I went from 85 to 95. I got 10 contracts filled. I had to take less credit because I got $157 a contract. And then I got 490 of them filled by taking 155 a contract. And that's how we sit now. That's how we sit now, essentially. We've got 500 short puts at 95 and 500 short calls at 120. There's $420,000 of extrinsic value. So in a perfect world, if Robinhood stays between 195 and 120, which is where it is right now, right? And we can all agree that 110 is in between those parameters. That 421,500 is fluctuating like crazy, is going to make its way from the extrinsic value, which is 5.5. That's how much extrinsic we have. That's how much all the options are worth right now that we're in, 5.6. It would make its way from that side of the ledger to the net liquidation value side of the ledger. So it would be a big time winning trade. So that is what's going on with Robinhood. Now let's focus on another one. I didn't touch this one today. Palantir. Palantir gone up to like 154 or whatever. Y'all all saw the screenshots on X. Everybody's, building a campfire and singing Kumbaya, right? Like, oh my God, we're rich on Palantir. So what did I do yesterday? Yesterday, I feel like I rolled. I rolled from 120 to 130. And you'll see these rolls here, top right. I went from, if you go all the way to the bottom, I started 100 to 150, 100 on the put, 150 on the call. This was, a while ago on 515. So I've been in this one for a hot minute, guys. And then I went from 100 to 110 on the put. Then I rolled the entire strangle, it appears. Oh, no, I added more contracts is what I did. So I stayed at 110 and 150 on the call, 110 on the put, 150 on the call. And then I rolled the entire position from June the 20th to July the 18th, picked up more credits. You'll see all the credits here, 424, 148, 446, 495, 65, 65. Took a debit there of 407 because I didn't like having 500 contracts on Palantir. So I was like, here's some of this money back. Let me log in to win. And then I started rolling, got $8.46, closed 80 more contracts, gave back 422 on 80 contracts. And then I was like, okay, I like it again. So I started selling more contracts, got 1038, got 64 on 250, got $1.88 just by rolling up my strike prices right on the puts. Because you'll see here, I started at 100 on the put, and now I'm already at 130 on the put, 155 on the call. So I started at 150 on the call, and now I ended up at 155 on the call. And that is the position that you see here. And this is the beautiful thing about this order chain. It just doesn't lie. It tells you everything you did, when you did it. It's up to me to tell y'all why I did it. And, I'd have to probably roll the tape, right? That's why I keep this, I chronicle this documentary, if you will, for you guys. But this is all of it. This is all of it right there, guys. Y'all can screenshot it or whatever, try to make sense of it. But where it stands right now is we have a sweet spot trade, a short strangle, 130 and 155. Probability of profit is 57%. The out of the money percentage is 77% on the short put, 56% on the short call. So it's telling me that they're feeling like Palantir is going to go up. So I'm trying to stay in this trade for a little while. And what I wanted to do first is going back to Hood real quickly. This is where it starts getting fun. I'm like, well, how much money will I make when I roll this thing? So I'm going to roll this thing to the 63-day cycle eventually. And I'm going to stay at 95. I would like to go to 125 at least. At least. It's a lot of money. $205,000. Not bad, right? Not bad. So that's something to look forward to. There's something to look forward to, guys. So I'm like, well, what would it look if I went a little more conservative? Let's just say it's I really wanted to position myself for the win because this extrinsic value is approaching levels that I'm excited about because I want to make $500,000 with Hood. So I'm like, well, what if I got, a little bit more conservative, if you will, and I went 90 on the put and 130 on the call? Is that worth it to me? mean, it's exciting, kind of, it's $67,000, nothing to sneeze at, nothing to scoff at, but it's not 200 grand. So it's like, I think I want the extra 130, 140 grand, and I'll deal with the discomfort. You know what I mean? But this achieves my objective, because what's my objective always is to get on the outer end of the expected move. And this would put me pretty damn close to that. Pretty delta neutral, 19 on the put, 33 on the call. If I went from 95, let me clear this out. If I kept the put at 95, it would be very, very delta neutral. And that would pay me more money. So if I did this, that pays more money, and that's pretty delta neutral. 25 on the put, 33 on the calls as far as the delta goes. And that's a happy medium, right? It's between that 67 and that 200,000. So that might be what it looks like. But I'll tell you why I wouldn't do that, because I got major OCD. I don't like the 95 strike and the 130. I want this to be at a 5, so I would either have to roll it to 135 or 125. So it's just little things. We all have our quirks, right? That's one of mine. So Palantir, how is it going to look like on Palantir, guys? 130 and 155. What's it going to look like when I roll to the 63-day cycle? Is I'm probably not going to do anything with the put. Now, mind you, we're going to have the answers to the test because earnings is coming up, right? So maybe Palantir helps me out and it goes down. It wants to keep going up because we met with Donald Trump and things look good. Who knows, right? I could just leave the put where it is and then just go take some pressure off of it and go to, like, say 165 or 160, even 160, pick up a fair amount of money, right? It's cool. 97 grand. That's an option. Or if it's not about credit, it's about being comfortable, then I can go to 170. I can go all the way to 170 for a credit. Small credit, 13 grand, but now it's like you're on easy street again. So again, it's what's the objective for you? You got to roll on purpose and you got to roll with the purpose. For me, it's always trying to find that happy medium of getting paid for the risk that I'm taking, but also increasing my level of comfort for staying in this trade longer. So those are kind of the things that I'm trying to achieve whenever I get into these situations. Anyway, let's talk about some easy trades, because they're not all hard right now. Apple's been a real easy trade so far. 195 and 130. Very delta neutral at 0.03. $23,000 already. Only been in this trade for 7 days. I mean, it's pretty easy money. There's still $150,000 of meat on the bone there. I have zero reasons for wanting to take this trade off. Zero reasons for wanting to take this trade off. I wish they could all look like that. I wouldn't make the returns that I'm shooting for, if you will, but I'd be sleeping a hell of a lot easier at night. I mean, you can make a case for why not just have 3,000 contracts on Apple and go to sleep, right? You can make a case for that. You wouldn't be that crazy. You wouldn't be that off base for suggesting something like that. Because trust me, I've done the numbers. Of course, freaking Tasty's going to be like, oh, concentration risk and all this other shit. But I mean, I put this at, like, say 190 on the put and 240 on the call and just went all in on Apple, you'd probably make with the portfolio. If I got rid of all the other shit, that's probably an easy $500,000 a month. Something to consider. I know I won't do it because I'm looking for $1 million a month, but I'm just saying there's a way there to make a pretty easy $500,000 a month for us. So it's pretty crazy. EOSP, this was one that was being a pain in the ass earlier because it went up to like 615 or something like that. And this is a position that I consider running a short strangle on. This was perfect for a short strangle. No conviction, not even a lot of interest in the company or anything like that. I haven't done much research. I just know it's a battery company. And it benefits from the big, beautiful bill, I believe. It's kind of what I read on X a little bit. but it was in that $5 range or four something range. And I was like, I'll just buy these shares. Then I just run the coverage strangle on it so that I have to monitor the position. Because whenever you own the shares, you don't really have to monitor the position so much. When you don't own the shares, you have to monitor the position because you have unlimited risk to the upside when you don't own the shares. When you own the shares, and if it goes up, the worst case scenario, you sell your damn shares for a profit, right? Provided that you're selling your covered call above your acquisition price of the shares. So that is all that's going on with EOSC. It's been a little bit of a pain in the ass. Luckily, it's a small position, but down $7,400 since I got into it, but it's still in the sweet spot. So I'm not going to do anything. I'm not going to do anything with it. Google is another trade that I got into not too long ago, 10 days out, up on the position, 12,000, down year to date on Google. And there's still $85,000 of meat on the bone here. 28 days out. Guys, I ain't doing anything with this one. This one is pretty sleep easy at night. You can make a case that I can just do half on Apple, half on Google, not make a lot of premiums, but it's a lot easier money than the other shit that I got going on. You can make a case for that, and I probably wouldn't be able to argue with you. HIMS. I was trying to get to $50,000, 50,000 year to date. We're getting close. We're getting close on HIMS. But it's very comfortable between our strikes of 40 and 70. And there's still $73,500 of meat on the bone. That's where you got to deal with your greed. You got to deal with your greed. So I know I said I was only trying to make 50, but now I'm like, well, maybe I can make 75. I don't know. I mean, it's, if I stay in this thing and I go and I roll it out eventually, I roll it out to the 63-day cycle and I get more comfortable and I go, say, 38 on the put and I go 75 on the call and pick up another 30 grand and turn it into a more relaxed trade, not necessarily a sleep well at night. This one's extremely volatile and there's short squeeze potential and all that stuff. But if my short squeeze, my strike price is at 75 on the call, I mean, shit, is there really an upside risk there? I don't know. So, it makes it very compelling. These are why some of these trades can stay on longer and longer and longer and longer. The only thing that I want to caution you with is don't overstay your welcome. Don't overstay your welcome, especially if it's a trade and there's no conviction. And that is exactly what HIMS is for me. It's a trade. There's not a lot of conviction there because I'm just not interested in the space. Everything that I hear about the company seems to be pretty good. There were some issues with the marketing and a little, I don't know, embellishing or whatever the hell they had going on. But I feel like it's growing pretty rapidly. It seems to be a pretty good company, reasonably valued because their CAGR is so high. But again, it's just you're not going to be interested in everything, and that's okay. You don't have to be interested in everything. So everything else is for the 63-day cycle, so it's really not worth talking about. The only one that I think that might be worthy of a mention will be SoFi. I've got 5,000 short puts at 19, and I've got 3,000 naked calls at 25 for January and 2,000 naked calls at 35 for January. I feel like these are absolutely not going to hit. There's an 89% out of the money percentage. And then the ones at 25 are at 69%. So we'll see what happens. I'd be glad to keep rolling these and rolling these and rolling these. There's $2 million of extrinsic value here. And I am going to try to get every last fucking dime. That's what I'm at with SoFi. Again, this is a super high conviction play. So it's just not a lot of things that cause me stress. And I'm also increasing the strike price on these puts. If you look at the order chain here on SoFi, you guys can see that there's been a lot of activity on SoFi. And I have just been increasing the strike price. Went from 17 to 19, 15 to 17. I mean, when I started with this thing, it was crazy. It was crazy. We were way over here at $10 puts. I mean, my goodness, right? So just been going up and up and up, making money. And eventually it's all going to look real good on this side of the house. The reason there's a negative on SoFi is because there was 150,000 shares owned on SoFi on Robinhood that we brought over. So they bring that P&L because so if I used to be trading over there up here at 18 at the beginning of the year and then it went down, they're like, oh, that's a loss. And I'm like, well, I own those shares at like $6. So is it really a loss? But that's the reason that accounting looks the way that it does. But I still think that it'll be positive by the end of the year, all those things included. But I can't use this as like for taxes. It doesn't really help me because I know that there's a lot of inaccuracies there. So hopefully, whenever we pull all the statements together between Hood and Tasty Trade, the accounting can figure all that shit out because I don't know how that's going to work, to be honest with you. Tesla, last one, short strangle, biggest one that I ever had. Now it's probably not the biggest one, but it was at the time. I have 200 short puts at 250, 200 short calls at 500. Pretty delta neutral, 21 delta on the put, 33 delta on the call. It's on Easy Street, guys. And again, a lot of extrinsic value between SoFi and Tesla. And that's on purpose because they are my backstop short strangles, if you will. So that's what I got going on. If there's a dump, I'll look to add to the puts. If there's a major pump, I'll look to add to the calls. And right now, I don't have any TSLL. I just sold TSLL for a nice profit at like 1180. I could obviously made more money because it was 150,000 shares. So if I still had TSLL, I could have made more money, right? Holding on to those shares. But I'm experimenting, not owning any shares and just trying to make $50,000 a day in theta. Because here we look at the data, it's 68,000 so far. Daily is what we're collecting here. So I'm just trying to stay true to that plan. I'm going to do it for like 3 to 6 months and see what's going on. The last two things I want to talk about is I added 2 positions today. I sold 501 short puts on CleanSpark, and I was hoping that it would tank a little bit. I was going to sell 1,000, but I was like, let me just sell these, see if it tanks. They'll pay me more, and then I'll put on the other 499. And then I sold 1,000 short puts on NEO at $4. Not selling short calls on either of these right now. This is just I'm trying to do the short puts, get real comfortable, and then if they pump, then I'll consider turning it into a short strangle. But I want it to be really wide, so I'm not going to just like sell it kind of narrow and then manage it because I just don't want to. I just don't want to. So that's what I got going on here with these guys. The reason Riot's not on there because 500 short puts on Riot was going to take over $500,000 of buying power. On CleanSpark, it only took like 40 grand. So I was like, that's crazy. I don't understand where Tasty Trade gets those metrics or whatever, but it is what it is. It's almost like I feel like they think that Riot is a lot riskier than CleanSpark, but just due to buying power constraints, because Palantir goes to 160, Hood goes to 120 overnight. This something's very unlikely to happen, but it could. You never know, right? You never know. That could cost me $1 million, maybe $2 million of buying power. So I can't afford to tie up $500,000 on my beloved Riot. So that's the issue there. And Riot's been running, so not likely to want to just buy shares outright on Riot. So I just have to wait for it to settle down. Hopefully it gets a re-rating with Tasty Trade or whatever. It could get back into my wheelhouse. So right now what I opened up was NEO and CleanSpark. And then the other one that I'm really eyeballing hard because I like it more and more is United Health. I'm considering adding another 150 short strangles to United Health. Love it at 250. I'd be happy to take ownership at 250. But then I'm like, if I add another 150 contracts, would I really be able to afford it? Right? That's the thing. Because whenever a stock gets to a level where you like legit want to own it, then you got to only put the amount of contracts that you could afford to take ownership of, right? Because that's 10,000 shares at 250, that's $2.5 million. So that's the issue there because I want to add more because I feel like United Health, Google, and Apple are the easiest strangles that I have in the books. I still think that Hood and Palantir are beautiful trades, even though Hood's recently gone against me. I feel super, super confident that this one's going to work out. I don't know if it's going to all work out on this cycle. I don't know, but we'll know more next week. But I'm staying tough. I'm not doing anything aside from I increased the strike price on the put, but I haven't touched the short call and I haven't rolled to the right. I mean, I'm actually trying to get all the way to the 14-day before I roll it because I'm very comfortable with it. And I don't know that I'll be able to do that with Palantir because I know they both have earnings. I think Hood's the end of next week, I believe. Or I'm not sure if it's next week. No, because next week would be the 25th. So we got a little ways. We got a little ways to go on Hood. And then Palantir, it says it's August the 4th. So we'll see. We'll see. I definitely want to make it to the 21 days, though, before I deal with those. And then also, I'm babysitting this Oscar thing. So Oscar might be the next one that we actually own shares on. And it'll be via assignment. And I'm pretty excited to take ownership of 25,000 shares of Oscar at $12.50. The goal will be to sell those shares at 15, get it off the fucking books, and move on because we don't want to own any shares on this channel or on this portfolio for long periods of time. If I take ownership of shares, it is strictly for a swing trade right now. That's it. Anyway, that's all I got. That's all I got. Let me close this out and let me see if there's any questions that I can answer. And I am going to go check on the workers because they're building our fence. And then after that, I'm going to go golfing this afternoon. So let me see if I can find you guys. Just sold more Oscar puts today. Transparency at its peak. It's what we do. There's people that claim transparency, and then there's my channel. At the end, covered calls in bull markets is a pain in the fucking ass. You will lose thousands of dollars. It can be a pain in the ass. If you're afraid to lose money in a bull market, just don't do covered calls. Hey, TJ, what's your thesis on UNH? I've seen some tweets on X, and I feel like there's too many negatives associated with it. So it makes a lot of money off of Obamacare, but it's a lot more diversified than that. I was digging a little bit using Grok's help yesterday between United Health and Grok. Let me see if I can pull up the conversation. It's a beautiful thing about this thing here.
Glad you think so. What's making it beautiful for you today?
Hey, Grok, can you tell me the key differences between Oscar Health and United Health? Let's see if Grok wants to talk to me today. Voice. Grok, are you there? Grok, wakey, wakey.
Yeah, I'm right here for you. What's up?
Can you tell me the key differences real quickly between Oscar Health and United Health and what their risks are if, let's say, Trump were to go crazy and repeal Obamacare or something like that? What would be the fallout of that?
Oscar Health and United Health are both health insurance companies, but Oscar focuses on individual and small group plans through the ACA marketplaces, using tech for a user-friendly experience, while United Health is a giant with a broad portfolio, covering employer-based plans, Medicare, Medicaid, and more. Oscar's nimble, with about 2 million members, mostly in ACA plans, whereas United Health serves over 50 million across diverse markets. Oscar's growth-oriented, losing money to gain market share, while United Health's profitable, but faces scrutiny for size and practices. If Trump repealed the ACA, both would take hits, but Oscar's more exposed. About 90% of its revenue comes from ACA plans. Without Obamacare, millions could lose coverage, gunning Oscar's customer base and pushing it toward insolvency if it can't pivot fast. United Health, with less than 20% of its business tied to ACA, would face losses but could lean on its Medicare and employer plan segments. Both face policy risk from regulatory shifts, but Oscar's smaller scale and reliance on subsidies make it shakier. United Health's got deeper pockets, but could see stock volatility from market panic. Fallout would be chaos. 20 million plus uninsured, spiking healthcare costs, and hospitals overwhelmed. Insurers like Oscar might collapse without a new system, while United Health could weather it but lose billions. It's a mess to even think about.
What is the latest with all the investigations associated with United Health? What are the real risks out there that you can find?
Recent posts on X show the U.S. Justice Department is probing United Health for Medicare fraud, focusing on whether the company faked patient diagnoses to boost Medicare Advantage payments by billions. A separate investigation alleges United Health paid nursing homes bonuses to cut hospitalizations, potentially harming patients. One case reportedly led to permanent brain damage. There's also an ongoing DOJ antitrust probe into United Health's acquisitions, sparked in October 2023. These investigations are heating up, with the criminal Medicare fraud case being the most serious. Risks for United Health are hefty. Fines could hit billions. Stock volatility is likely, already seen with a recent dip, and reputational damage could erode trust with regulators, providers, and customers. If convicted of fraud, they might face stricter oversight or lose Medicare contracts, a huge chunk of their revenue. Worst case, executives could face criminal charges, though that's rare. The company's size might help it absorb penalties, but prolonged legal battles could drain resources and distract from operations. Smaller players like Oscar wouldn't survive this level of scrutiny, but United Health's diversified revenue gives it a buffer. Still, it's a rough road ahead.
Grok is pretty handy, guys. Pretty handy. Again, I just started digging, and I just don't like how reliant Oscar Health is on Obamacare. I'll give you all a story. We'll end with the story. So back in the day, I used to sell home security and Dish Network, and there was a company called FaxMail. Back in the day, facsimile. This is where you get it's like an email to a fax machine, and it prints out the paper for you. It's a fax. I'm showing my age. Right? This is like in the early 2000s. So there was a company owned by Bob Woolard named FaxMail. So he essentially had a call list of thousands and thousands of fax numbers, and he would send our promotion on the fax, like free cell phone with AT&T, right? It was the one rate plan, $1,000, $100 for 1,000 minutes, nationwide call, free roaming, long distance, all that shit, right? And then with home security and Dish Network, it was like free satellite system, free installation, packages, $69 a month or whatever, DVR, all this other shit. And then with home security, it was like a free system installation, 3 months, up to $1,000 of equipment. You just got to sign a 36-month agreement or whatever. So he would just do that over and over and over again, and our phone would ring. 402 easy. 210-402 easy. EAZY. $32.99. The name of our company was Easy Digital. So that's the number. That's the number that we got. Grok's listening to me. So anyway, we had a big concentration risk with FaxMail because we relied on Bob to send out those faxes, and he was doing like 5,000 faxes a day, and 5,000 faxes a day equated to about 20 to 30 phone calls. And those 20 to 30 to 40 phone calls, I was answering the phone personally, would get anywhere from 5 to 10 sales on a daily basis, making about $1,000 a day. As a small business owner, I was high on the fucking hog. Well, some laws passed, and now Bob couldn't spam a bunch of companies that were getting a bunch of DNCs, do not call, or put me on the do not call list. And Bob wasn't putting people on the do not call list. So he would keep spamming them and spamming them and spamming them. And then they were just like, half of my calls at one point were like, hey, take me off the effing list. Take me off the effing list. And I couldn't pivot from that. They tried to get a van going. We're just going to go knock door to door and all that stuff. But it turned out that I really didn't want to do it anymore. I used to do it when I was younger. And I was like, dude, I'm like, approaching 30 years old now. I'm going to be knocking door to door. Like, fuck that. It's hot. There's other ways to make money. So I couldn't pivot because FaxMail was my bread and butter. It was the lifeblood of the business. It was the marketing arm. It was the marketing arm for our business. So eventually we went out of business because we couldn't figure out another way to get low-hanging fruit, if you will. So when I started researching Oscar Health, I was like, Obamacare is their low-hanging fruit. So I don't see any diversification in how they go after other customers. And I was like, it just scared me a little bit. It just scared me a little bit. And it's a personal bias because I had lived a life where I relied on one source to bring me my prospective customers. And when that source was no longer available for me, my life got turned upside down. I faced a foreclosure. Luckily, Chris was able to help us sell that townhome. It was going to be an absolute shit show for me personally. So when I started reading a little bit about Oscar Health and utilizing Grok to help me as well, I was like, oh shit, I'm living out a nightmare again. I don't like this concentration risk on just, relying on fucking Obamacare when I know that we have a president that can't stand Obama or Obamacare. So he would love to disrupt that industry, I feel. Anyway, what happened to Bob? I don't know. I'm gonna call Bob, see if we can get him on the channel. I don't know. I have not seen his channel. I know he had changed it to like Celsius Investor or something like that. It was no longer the boring investor, but I'll send him a text. I'm gonna send him a text today, Bob, and option and see what's going on with Bob. I'm now researching into NVIDIA. Why did the FOMO kick in so hard? I don't know. I mean, I got NVIDIA on there too, I think. It's an amazing company. I just never been real interested in it. Yeah, but I've got, this is 63 days out. I'm sitting at 145 and 190 on the puts and calls. I can't believe it's fucking trading at 172. I can't believe half of this shit. Am I the only one that thinks this market is just like extremely frothy and extremely toppy, or is that just me? Am I alone here? This is just crazy. I think the reason that I'm kind of excited about United Health, it's the only one that could potentially give me a pretty decent entry point. Everything else seems ridiculous. It seems absolutely ridiculous. It's ridiculous. It's absolutely ridiculous. It's crazy. When you roll, you increase the price. Do you roll for money? And what happens when you buy the roll up? Yes, at the end of the day, it's just a game of credits and debits, right? But you got to keep in mind, there's losses baked into rolls. So whenever I'm rolling a strangle, it's a lot different because now I'm not like wheel tracking or anything, right? So at the end of the day, whenever I'm selling a short strangle, just to make it real simple for everybody, at some point, I need that strangle to expire worthless. That way I know that I for sure made a shitload of money. How much did I make? All the credits. Because all the debits that were baked into those rolls, those all come off the table. So I got to widen up that goalpost enough to make it to expiration one day, or at least 7 days to expiration. I can milk as much of that data as I can. Did you see Scotty Scheffler's comment where he was saying winning is naturally satisfying? It's so true. I haven't seen that, but Scotty Scheffler is a UT guy like I am, so I like me some Scotty Scheffler. Well, good info from Grok there. Lulu under 230. So are you telling me that you're not retired yet, VR? What's going on? I got to run, man. I appreciate you guys. I hope y'all appreciate the level of transparency. I come at you guys, whether the market's going up, down, sideways. We're going to sell puts. We're going to sell calls. We're going to collect premium. We're going to roll and make dollars and cents. Sometimes it'll be short strangles. Occasionally I'll have covered strangles. Occasionally we'll buy the timely leap. But the one thing that you can always count on this channel is transparency. TJ the Wheel Deal signing off. As always, Mary Sky, stay blue, Sox green. Peace out. God bless you guys. Have a beautiful weekend. Spend time with your family. Spend time with your God. Do things that are a lot more important than just the stock market.